Right. So I'm going to go through Marx, a bit of each of those areas again to remind you how much Minsky brought all this together. And you see Marx talking about cycles. And again, this is people who only read the first few middle chapters of Marx and Capital One don't ever see this sort of work, but it's there in Theories of Surplus Value and in volumes 2 and 3. And he talks about these cycles in capitalism: states of inactivity, mounting revival, prosperity, overproduction, crisis, stagnation, state of inactivity, etc., etc. Straight out of Marx. And then he says normally when you have a prosperous period, he thinks you're going to have a low rate of interest, and then a rise of interest, so changes in the rate of interest being part of the cycle from one part of the stage to another. But he said more generally, a period of brisk business is a period of elastic credit. But then that leads to a crisis, and prices fall and wages fall. But then what you find is you've got, rather than the strong demand for loans distinguishing depression from prosperity, it's the ease with which you can borrow during prosperity and the difficulty of just borrowing during a depression. Now again, this is a very dynamic, cyclical, financial Marx. It's not the Marx most people think about, because Marx has been ruined in people's interpretation of him, not just by his enemies, but I think more so by his so-called friends, who've stuck with the labour theory of value, very pedestrian vision of Marx. That was not what Minsky read out of Marx. And he also, Marx talked beautifully about the perils of letting the financial sector take over capitalism. So as much as he criticised capitalism in general, he was in a sense a fan of industrial capitalism and a critic of financial capitalism. And I love this particular phrase here. He says, the credit system, which has its focus in the so-called national banks and the big moneylenders and usurers surrounding them, constitutes enormous centralisation and gives this class of parasites the fabulous power not only periodically to spoil industrial capitalists, but to interfere with the actual process of production in the most dangerous manner. He could be talking about Harvard MBA graduates here from my experience of them. And then this gang knows nothing about production and has nothing to do with it. They're saying you shouldn't let the financial sector take over capitalism. And in a sense, that vision is certainly part of Minsky as well. Fisher talks about disequilibrium being an essential part of your vision of the economy, and again you can find Minsky talking in the same way. So he's saying here that capital losses and gains aren't symmetrical. There's a ceiling to the losses you can take before you go bankrupt. Any loss beyond that is passed on to your creditors because you then don't pay them back. And those capital losses themselves can cascade through the rest of the economy. So it's all about disequilibrium. And again, he mentions the word debt deflation there, so you can see the Keynesian Foundations. So he finally said, he called it unreconstructed Keynesianism. But it also sounds like properly understood Marxism. Because he said capitalism is inherently flawed, being prone to booms, busts and crises and depressions. And notice this paragraph, this sentence, this instability is due to characteristics the financial system must possess if it is being consistent with full-blown capitalism. In other words, you can't get rid of this inherent part of the system. I believe you can tame it to some degree. You can control the extent to which this goes across into speculation on financial assets rather than in investment speculation. But the fundamental cause of this is we live in an uncertain environment. When you're trying to profit, though you live in an uncertain world. So he said such a financial system will generate both signals that induce an accelerating desire to invest and financing that investment. And then, of course, of that investment involving losses which cause a crash later on, and on goes the cycle. So it's a Marxian view of inherent crises, not something exogenous shocks disturbing an otherwise stable system, but an endogenous tendency to crises and booms and depressions. It's purely cyclical, not an equilibrium vision. And that's the foundation. But we often talk in economics about micro foundations. But I'm a critic of the whole idea that macro needs micro foundations. But you need an intellectually coherent story all the same. And you can't get a theory of two price levels out of a Marshallian vision of pricing. And if you have micro based on utility maximising behaviour and etc., you just simply can't explain the two price level idea. So when Keynes came up with the concept of two price levels, that didn't fit into the Marshallian mindset at all of the neoclassical economists who were trying to understand him. So they forgot about it. It disappeared. So you need a different foundation for this price analysis. And as I've shown in the earlier lectures, you go back to Marx to find this argument for multiple conflicting price levels in capitalism. Not all prices being based on marginal utility and marginal cost, but an incredible clash in a coherently structured way, a clash between different price levels. So you find Marx arguing for at least two price levels, actually more than two. Commodities based on a markup of cost of production. You get the idea that the wage will involve a struggle over distribution of income as well. Asset prices are based on expectations and other dynamics as well, as I covered in the second lecture. So that gives you a foundation for this multiple price level analysis that's also part of Minsky. And I think I might just dive through this fairly rapidly. The labour theory of value component of Marx talks about equilibrium exchange, and money is seen as an extension of that, where gold is the money commodity. That's the abstraction that Marx uses in the first few chapters of Capital, or the first volume of Capital. And the price of gold reflects the cost of producing it, etc., which is an extremely pedestrian analysis. The interesting stuff comes after the first 7 chapters, and as I said, it's gone on that based on that philosophy of Hegel, of dialectics. And just quickly to explain that one again, I know that was with a fairly rapid introduction to Marx's ideas, but it talked about a unity existing in a society. Society focuses upon some foreground aspect, therefore the other aspects are pushed into the background. You therefore have a tension between the two. And that tension both explains things like where profit comes from, but also explains social change over time. We apply it to finance, you get that money is a commodity and a non-commodity. It's essential for exchange, which makes it a commodity, but it's not produced by other commodities. So therefore, what's the price of capital? It depends upon the expectations that the borrower has about the profit to be made from borrowing that money. So, actually, I might just dive through that slide. I think I'm repeating myself a bit there from yesterday. I am indeed. Let's jump over those two parts. And go to here. So that's the background of the Financial Instability Hypothesis and the way it integrates Marx with the dialectics of good money, labour and money, Schumpeter talking about evolutionary dynamics and the role of credit, and Keynes talking about expectations and speculation and uncertainty, and Fisher about debt and deflation, and Kalecki about increasing risk. All those elements come together. And what he adds to it, what you find a special concept that Minsky adds, which comes out of blending those together but is uniquely his, is the idea of the tendency for expectations in capitalism to become euphoric, and therefore lead, of course, to investments which are going to have losses incorporated in them. Because you're not going to make sensible decisions when you're making euphoric, when your basis for making those decisions is euphoric expectations. So, and here is contrasting the argument that the crises we have are due to man-made imperfections in the financial system versus the fact that it's inherently flawed, and he's definitely in the inherently flawed case. So he tried to model both booms and busts. It wasn't a case, as Fisher did, of explaining a crash after too much debt's implied. He's also trying to explain both the boom and the bust. So he said, to do that, we need a theory that makes a Great Depression one of the possible states of the capitalist economy. He said, if you don't have a theory which can generate a Great Depression, then you don't have a theory of capitalism. Now that effectively rules out the whole neoclassical endeavour, because fundamentally with the neoclassical model you get stable equilibrium. So on that basis alone he's saying that's not a model of capitalism. So you had to treat financial crises as normal events. They had to be something which came out of the normal behaviour of the economy. And he had to also explain why they hadn't happened from 1948, after giving a few years for the war to get out of the way, until the mid-1960s when he said he saw the first financial crisis occurring. And he said that was a period of financial tranquility. There was no period between 1946 or 48 and 1966 where there was a financial crisis or anything even close to a debt deflation. but said since 66. Now notice how far back he's talking. He's talking virtually 50 years ago, as saying a tendency for financial crises became dominant in capitalism. And if you look at the historical record, that's correct. But looking from 48 to 78, he said the first crisis that actually occurred was a credit crunch back in 1966. Now, this was a company, I think, called Penn, the Penn Central Railroad. Okay, Penn Central Railroad failed, and there was a run on commercial paper, which is a way that corporations raise short-term finance. And then one in 74, 75. Personally, I identify that as the major transition from a period of capitalism being industrially dominated and relatively robust to becoming debt-dominated and breakdowns. If you take a look at 1973 to 75, there was a huge jump in the average rate of unemployment at that period. We never got back to the level of growth we had back in the 50s and 60s up to 1973. And then he talked about another event with the Franklin National Bank failing after running its overseas branch back in 73. So he said, what we've now got is a recurrence. After 66, we're starting to see the same sort of financial volatility that we saw before World War II. So we have to regard this as systemic, endemic to the economy, rather than just accidental events which can be blamed on particular behaviour of particular banks or particular governments. So the anomaly is not the experience we're going through now, that's the regularity. The anomaly is the 20 years of stability after the Second World War. And you can explain that, he said, on the basis of the extremely robust financial structure that resulted from the Great War. Now, I don't have a chart of this in this particular lecture. I'll add that when I come to Flaxo and give a rather more leisurely lecture on this whole topic than 5 intense lectures like I'm giving right now. But if you take a look at the level of private debt in America after the Second World War, it was less than 40% of GDP. It's now about 180% of GDP. So we've gone from debt level being way, way below anything in the previous 40, 50 years to debt levels which are far greater than any time in recorded history. And I'll bring a chart of that for tomorrow's lecture to show you what I'm talking about. So talking about being financially robust, it fundamentally meant the level of private debt was incredibly low. And therefore the leverage, the risk that people were facing was also quite low. And we need to get, that's a sort of society which is more likely to be robust, whereas since that, with accumulating debt, we're more back into the historic 19th century experience of crises every 10 or 15 years. Now, what you get when you take a look at the historical record of the 19th century, this fits what Minsky's talking about. Now, that's a look at the 19th century trade cycle. So the very thin lines are the level of manufacturing output, annual change in terms of a ratio rather than percentages, wages, which are the purple line, and then wholesale prices up and down like crazy. You can see plenty of periods of deflation from 1864, 1875, 1877, 1890, etc., etc. So that period is a very useful period for saying what is the actual nature of a capitalist economy, because back then the government sector was a fraction of the size it is now. Now, a lot of, particularly Austrian economists, will criticise the government as a cause of all the instabilities of capitalism. But fundamentally, the government barely existed compared to what it is now, back in the 19th century. And yet we had these financial cycles. So financial instability is an essential part of a capitalist economy. And those are elements that being a pro-cyclical prices rising during a boom, falling during a slump, frequent falls of wages, negative change of wages, and every 20 years or so you had a financial crisis. But we still get a difference between that the 1973 on period of instability is still different to what happened before the Second World War. And what he's arguing here is the Federal Reserve and the government sector have come in and rescued the economy when these crises have occurred. So rather than having the 19th century nature where they became quite profound and deep, the government would come back in and rescue the economy and stop them becoming as deep. But when at the time Minsky wrote, the impact of this was accelerating inflation. Now he wrote at this stage just as Volcker was taking over the Federal Reserve and suppress the economy to drive inflation out of the economy. So his expectation of rising inflation didn't come true. But certainly what did happen was rising levels of private sector debt, because rather than that debt being eliminated by a downturn, the government in some ways, by restoring it, let that debt continue ratcheting up. So how do you turn this into a theory? Well, you've got to build on your antecedents. So this is where he starts building on Marx in particular. But he says where you start in building a theory of the cycle, you've got to choose some point in time. And he said the sensible point to begin your analysis from is some point in the economy where it's doing well. Okay, it's a cyclical economy, but it's doing well. And you then got debt inherited at that time based on previous investing decisions, which include a period where there was a crisis. And you've got, after the crisis, your margin for safety is expanded. You are, because you've had a debt-induced crisis, you've got a larger buffer. You don't want to get into too much debt. You're conservative about the amount of debt you'll take on. You're sensible in how you evaluate what your future prospects might be. But the longer the economy continues behaving in a tranquil way, the further back in time that crisis recedes, and the more you think, we're over the danger is past. And at the same time, the capitalists who are more adventurous, who got more into debt, made a larger levered profit than you did. So it becomes obvious after a while that it pays to lever. Now, what you then realise is, well, you have too large a margin for safety. So your willingness to take on debt starts to rise, and the value you put on financial assets also starts to rise. And that therefore increases asset prices. It makes it profitable to gamble on rising share prices and rising house prices. And you pass from a period of tranquil growth into a period of a boom. And that, of course, leads to speculative excess, because in that boom, people can make money by gambling on rising asset prices, even if they're losing money on the cash flow from the assets they've purchased. So he says stable growth is inconsistent with the way in which we finance investment in a capitalist economy. And he said, therefore, the fundamental instability of a capitalist economy is upward. It's not downward. If you read a lot of the Marxian literature in particular, people like Magdoff and Sweezy and so on, and some of the early post-World War Keynesians, they talk about a danger of underconsumption, producing more than we can actually consume, which is a negative, a depressing, seeing a tendency towards depression. And Minsky's argument is no, what capitalism has is a tendency towards euphoria. Not a bad thing in some ways, more of a positive upswing. But what it means is you'll take on more debt than you can handle. And what therefore happens, a period of stable growth will become a period of speculation and upwards boom, which you finance by borrowing money, which of course gives you liabilities you are obliged to repay, and some of those liabilities you won't be able to repay because your expectations won't be fulfilled. Therefore you'll have bankruptcy and you crash back down again. Now that's missed completely because of the equilibrium nature of ISLM analysis. And Minsky became a strong critic of that, because whether you look at, whichever way you look at neoclassical and ISLM models and ASAD, whether you say it from a so-called Keynesian or a neoclassical point of view, they both leave out time and debt. And therefore you don't have any possibility from that point of view of seeing a crisis caused by accumulation of debt over time. Now, Minsky noted in doing his history of economic thought effectively that Hicks had rejected ISLM by the time he became aware, by the time Minsky became aware that ISLM didn't reflect Keynes properly. He also noticed that Hicks had rejected it as well, and for precisely the same reason. He says Hicks repudiates the potted equilibrium version of Keynes in the ISLM model. So this is one thing I find very frustrating about economics. Economists like Hicks will build an equilibrium model of the economy. Lesser economists run with that model, and some decades later the person who developed it, Hicks, looks back and says, hang on, I shouldn't have used equilibrium there. That was false. But it's too late. They've let loose the equilibrium demon again, which is why I want to teach on equilibrium economics. So what you get, what you can't see from an equilibrium point of view, you can't see this evolution of riskier behaviour. You can't see a change in expectations from conservative to euphoric. So, Minsky's classic phrase, this is one actually, I should have brought on a t-shirt today. I forgot to bring the t-shirt along, but I have a Minsky Stability is Destabilising t-shirt, which I produced for the campaign to raise money on Kickstarter for my Minsky software. But this is the classic phrase from Minsky: stability or tranquility in a world with a cyclical past and capitalist financial institutions is destabilising. So rather than saying you have a tendency towards equilibrium, it's saying if you spend any time in equilibrium, your expectations will drive you away from equilibrium. So it's a fundamentally disequilibrium view. And therefore that secular increase in debt that comes out of those rising expectations will make you more fragile and susceptible to a financial crisis. So this is my classic way of trying to describe Minsky's hypothesis. There are many ways of doing this. People talk about hedge, speculative and Ponzi finance and transitions between them, more of a micro-oriented framework. I tend to take a top-down view of Minsky, and this is the way that I've always seen him talking about capitalism as a systemic thing rather than looking at individual behaviour up. He said you start with an economy in historical time. And let's say we chose, for example, the 1990s, which was the big recession in America before the crisis we're in now. So say 92, 93. So there's been a crisis back in the recent past, the 1990s recession that brought Bill Clinton to power. And because of that crisis, firms and banks are both conservative about the level of debt they'll take on and the valuation they put upon assets. The market is depressed, and the only investment that's taking place are going to be conservatively estimated investments. But because the economy has recovered, most of those projects succeed. So what you start seeing, here's the beginning of the dot-com bubble and the internet bubble, telecommunications bubble. So firms start to revise their risk premiums, thinking they were too conservative beforehand. And that applies not just in a sort of asymmetric information way, which is the way Joe Stiglitz interprets this sort of logic, where the investor knows a lot and the bank doesn't know very much at all, and therefore that's why you get the imbalance. Minsky's really saying they both have the same expectations. Okay? It's not a case of asymmetric information, because how can you have information about the future? But it's shared expectations about the future that are both euphoric. That's the essential difference between Minsky and the neoclassical way of trying to interpret Minsky. So you get both sides of the borrowing equation except a higher level of debt to equity. And both sides start to value assets more highly, so you start to get rising asset prices. Here's the whole bubble in the stock market back in the 1990s. Then you get to what Minsky calls the euphoric economy, where people are absolutely optimistic about the future. Now, in some ways that gives you a positive feedback loop that's good, because you have less risk aversion, so there's more investment, and therefore the economy grows faster because of that increase in investment. But it also means you start to value assets more highly, and it therefore makes it profitable to borrow money and gamble on asset prices. And you therefore have an increased willingness to lend money, so the money supply also expands. I'll cover this in more detail in Lecture 5. And you have riskier investments being enabled as well by that high level of borrowed money. And finally you get well, not the evolution, they've always been sitting there. You start to fund what Minsky calls Ponzi investors. Now the essential thing about a Ponzi financier is the cash flow they get from their investments is less than their debt servicing costs. So in a technical sense, they're bankrupt. How do they keep on going? They sell, how do they profit? They profit by selling assets in a rising market, but they keep on going in the meantime by borrowing money to cover their shortfalls. So they have an insatiable demand for investment money. And my favourite example of this is because I'm Australian, involved an Australian so-called entrepreneur, ultimately exposed as Ponzi financier, called Christopher Skase. Does that name ring any bells here? Didn't think it would. He built 5-star hotels up and down the coast of New South Wales and Queensland in Australia. And he was a classic Ponzi in that his revenue from those 5-star hotels was far less than his debt servicing costs. But he was always trying to expand his empire. And his main financier was a company called, what's it called? I've forgotten its name now. Run by a family, a father and son team called Larry Adler, and the father, and I've forgotten the son's name, which is a bit of an insult, but the son's still alive, but I'll live with that. So the father and son were the main financiers to this guy. And they used to play a game where each time Christopher Skase came to see them, they'd swap who saw him, and they'd put their interest rate up by 1% each time. Wanted to see at what point Christopher Skase would say no. They got to 25% rate of interest, and he simply said yes every time. Because if he said no and didn't get the money, he'd be bankrupt the next day. Now, the way we saw this classically happen, have you heard of the company called MGM? Metro Goldwyn Mayer. Okay. He made a takeover bid for MGM, offering to pay at the time $3 billion to buy MGM. And you've heard of Corcoran at all? Okay, some of you have. Corcoran's a famous vulture capitalist, venture capitalist, all sorts of combinations. Corcoran was on the board of MGM, and he did an investigation of Christopher Skase's finance. He said, this guy's losing money hand over fist. Don't let him take over MGM. And he blocked the takeover bid. So, having made a $3 billion takeover bid for MGM, which was turned down, Christopher Skase went bankrupt the next week because he couldn't pay a $12 million loan instalment. Now, how can somebody make a $3 billion takeover bid and go bankrupt on $12 million later? The reason was he was bankrupt at the time he made the $3 billion takeover bid. But if he'd made the bid, he would have gone to a bank, borrowed $3.5 billion, paid the $12 million out of small change, out of the money he'd borrowed, and kept on going. But fundamentally, he was bankrupt all the way through. That's the essence of a Ponzi. So they've got a desperate demand for money because they're fundamentally insolvent all the way through. So they've got to borrow to cover those shortfalls until they can sell the next asset. So they're driving up interest rates. They're demanding the money. They're willing to pay these high rates, and others have got to follow along with them. This drives up the level of interest. It drives up the prices as well. But of course, all the way through, you've got losing investments going on. And this classic with Christopher Skase. If he'd got that $3 billion takeover bid approved, he would have had the money to cover the $12 million loan instalment 1 week later. All it takes is a timing mismatch like that, and somebody you think is wealthy goes bankrupt, the business they have gets shut down, and the economy accumulates more and more losses like this, and finally crashes. So when that crash occurs, many of these euphoric expectations type investments fail. Even conservative projects now become risky because of the high rate of interest. Non-Ponzis might decide to sell assets, all sorts of ways which can bring the cycle to an end. But the mass asset market crashes. That trend of rising asset prices goes into reverse because the Ponzis are the first ones to fail because they can't sell their assets for profit any longer. Yeah.
So what forced all this process is just the interest rates?
Pardon? No, not just the interest rate. Well, rising interest rate is part of the whole process. There's a whole lot of cycles going on here at once. But if you've got people investing on euphoric expectations, then the percentage of investment which are actually going to lose money is going to rise. Okay? Because if you can't know the future. It's uncertain. Some investments are going to fail. Some are going to succeed. The proportion that are going to fail will rise as people's expectations get higher and higher. So you've got accumulated losses which have to be covered by more and more debt. That's one factor. Interest rates can drive up and make even projects which were conservatively costed, were making money, might become loss-making because of higher interest rates. And asset market strategies which are based upon selling assets at rising prices fail when the rate of asset prices also goes into reverse. And I'll show you a bit of mathematics tomorrow to show that there's also a logic between accelerating debt being necessary for rising asset prices. There's a whole lot of factors that could bring it unstuck.
Why do prices go down?
Pardon?
Why do prices go down?
Asset prices, because they're based on, again, fragile expectations to begin with. You've overinflated them. You get massive overinflation of prices which have to be validated by rising returns. Only if you get rising income out of those assets can you actually finance those prices when you finally have a crash. I'll show you a model of this tomorrow. Yeah?
Steve, is it true that during the expansionary phase of the cycle, the central bank increases interest rates and suddenly the interest rate will become a trigger mechanism, and will, in some sense, in the Minsky view, will cause the reversion of the cycle.
That's part of the factor as well. Certainly, we saw the Federal Reserve did do that during Burns.
The fear of inflation will generate a reaction.
Yeah, but you get this you get this endogenously anyway. It doesn't have to, but it does. That is certainly an added factor. The attempts of the Reserve to control it by putting up rates can actually trigger a crisis. But it's not the only trigger. That's an exogenous trigger, if you like. I'll show you a model tomorrow of an endogenous process, where it actually comes out of the fact that you're borrowing money that's going to lose. You're based upon your expectations of the future, take into account current distribution of income. But if you cause a boom, wages rise, you've got more cost in that sense than you expected to have. You can't make as much profit, etc., etc. So it's endogenous processes, but a whole mass of them, and ones we need to model properly to understand what the dynamics of a capitalist economy are. But it certainly starts from the fact that you're investing more than you should because of expectations becoming euphoric, and therefore a large part of the investments you're taking on are going to make losses, which you have to cover by borrowing more money. And at some point, of course, your capacity to do that will exceed your capacity to finance it, so you become negative. And then you can't cover the finances, you do go bankrupt, and your bankruptcy feeds through the rest of the economy. Not a straightforward process to describe verbally, which is why I want to get mathematical models of this. When it happens, you have a crash in asset prices. The expansion of the money supply goes into reverse. Investment evaporates, growth slows down, and you're back where you started again. And you think of the period from 1993 to 2000, that was the cycle we went through then. From depressed expectations after the crash of the 1990s, to recovery in the early 1992-93 period, to a totally euphoric boom, all the investment in telecommunications, internet, all the dot-com companies that went bust, and then the crash of the market, and then the government steps in and does a rescue, of course, in 2001 and so on. Now, Minsky said, what happens at that point? Well, he had two other delineating factors. If you have high inflation, then that debt can repay even though you've got a depressed economy, the rising current prices means you can finance the debt you've taken on. And that's what happened back in the 1970s and early 80s when you had high inflation. So that's what causes stagflation. So Minsky has an explanation for stagflation from a Keynesian point of view, which of course the argument that there was no Keynesian explanation for stagflation was the major reason for the neoclassical revival back in the early 1970s. But that will then renew the cycle. You go back to where you were again, which is what happened back in the 1970s. Now, you also have the government sector, which I've left out of this particular slide. I'll put it back in again. But if the government sector then spends money to boost the economy once more, then that can also validate. So high government spending can attenuate the cycle. Now, what I'm going to do in the next lecture is turn all this into a mathematical model. But I'll do it using my Minsky software to make it slightly more palatable than a whole mass of differential equations. So thank you for attending, and see you tomorrow. Any time, we've got time for questions. People want to actually have a bit of a debate now. Normally I've gone too far without time for